Wall Street has silver in the wrong box, and that single mistake, a classification error that has persisted for decades, is the reason silver just did something that shocked every analyst who was using the old model. It went from $15 in 2020 to $120 in January of this year, and then it crashed back to 70 in a matter of weeks, and the people who are confused about both moves, both the rise and the fall, are confused for exactly the same reason. They are looking at silver through a lens that stopped being accurate somewhere around 2021. They are calling it a monetary metal, a gold substitute, a rate-sensitive, dollar-dependent inflation hedge for people who cannot afford gold. That framing was reasonable in 1980. It was reasonable in 2008. Today, in March of 2026, it is dangerously incomplete, and the gap between the old framing and the new reality is where the most significant repricing opportunity in the commodities market is sitting right now. Here is what I mean. When a professional fund manager opens a model to price silver, they run the same variables they have always run: the federal funds rate, the real interest rate, the dollar index, gold's price, speculative positioning from the weekly CFTC report. Those variables produce a fair value number. That number tells them whether silver is cheap or expensive, and that model has been used by every major bank, every hedge fund, and every commodities desk on the planet for 40 years. The problem is that model was built for a world where silver's demand was driven primarily by photography, jewelry, and financial speculation. In that world, when rates rise and the dollar strengthens, silver falls. When rates fall and the dollar weakens, silver rises. Simple, predictable, modelable. But here is what has happened to silver's demand while those models were running on autopilot. In 2014, the solar energy sector consumed 11% of total industrial silver demand. By 2024, that figure had risen to 29%. The single largest industrial consumer of silver on the planet is now not a jewelry manufacturer or a photography company. It is the global solar industry. In 2024 alone, solar photovoltaic manufacturing consumed 197 million ounces of silver, 197 million ounces. That number is so large that it is hard to contextualize, so let me try. Total global silver mine production in 2024 was approximately 815 million ounces. The solar industry alone consumed nearly a quarter of everything pulled out of the ground that year just to make solar cells. And that is not all. Electric vehicles consume 67 to 79% more silver than a traditional combustion engine vehicle. A single EV requires between 25 and 50 grams of silver for battery management systems, power electronics, and thermal management. Global EV production is projected to overtake combustion engine vehicles as the primary source of automotive silver demand by 2027, 1 year from now. The transition is not coming. It is here, and it is already showing up in the consumption data. Now add artificial intelligence. The IEA projected that electricity demand from data centers, AI infrastructure, and crypto would double by 2026. The build-out requires physical hardware, servers, connectors, circuit boards, busbars, power switching systems, all of which are dense consumers of silver. A single 500 megawatt solar array built specifically to power one hyperscale AI data center requires approximately 300 metric tons of silver, 300 metric tons for one data center. Microsoft, Google, Amazon, and Meta have committed hundreds of billions of dollars to expand their AI infrastructure. Every dollar of that commitment is a downstream silver demand signal. A research piece published on Seeking Alpha in January of this year estimated that US and Chinese data centers alone consumed approximately 350 million ounces of silver in 2025, more than 50% of total global mine supply just in those two countries. This is not an investment thesis built on speculation. It is arithmetic. The global industrial base has structurally rewired its relationship with silver. The metal is now embedded in the physical infrastructure of three of the most capital-intensive build-outs in human history happening simultaneously: the decarbonization of the energy grid, the electrification of transport, and the build-out of artificial intelligence infrastructure. All three are growing at double-digit rates. All three require silver that cannot be substituted away easily because of its unique properties: the highest electrical conductivity of any element, the highest thermal conductivity of any metal, unmatched performance in high-frequency data transmission. Engineers have been trying to substitute cheaper metals for silver in solar cells for years. They have made modest progress, but as the Silver Institute reported in its February 2026 outlook, even with aggressive thrifting using less silver per individual cell, the sheer volume of solar installations globally means total solar silver demand remains historically elevated. You can reduce the silver content per panel, but when the number of panels being installed grows 15% per year, the math still runs in silver's favor. Here is where it gets important, because here is the number that should stop you cold. According to the Silver Institute's February 2026 annual outlook, which is the most authoritative source on global silver supply and demand, the silver market is now entering its sixth consecutive year of structural deficit. Sixth consecutive year? That means for 6 straight years, the world has consumed more silver than it has produced. The cumulative shortfall since 2021 has now exceeded 800 million ounces. That is an entire year's worth of global mining output that has been drawn down from above-ground inventories. The 2026 deficit specifically is projected at 67 million ounces. Every year the deficit runs, that above-ground inventory shrinks further. Every year it shrinks, the market becomes more vulnerable to a price shock when the next demand catalyst arrives. And yet the models that Wall Street uses to price silver still treat it primarily as a monetary metal. They still benchmark it against the real interest rate and the dollar index. They still run the 1980 correlation. That is the misclassification. That is the error. And that error is what produced the confusion around silvers. January high of $120. Analysts looked at the price and called it a bubble because their models built on the monetary metal framework said silver was overpriced relative to rates and the dollar. They were not wrong about the model. They were wrong about what they were modeling. They were pricing a monetary metal. They should have been pricing the critical raw material of the digital and energy transition. Those are very different assets with very different fair values. Now I want to address the crash, because what happened between January and today is important, and most of the coverage of it has been misleading. Silver hit approximately $120 per ounce in early January, on January 30th, when Kevin Warsh was announced as Trump's nominee to replace Jerome Powell as Fed chair. Silver dropped 39% in a single session, the worst day for silver since March 1980. If you saw that and concluded that the silver story is over, you were making an understandable but analytical error, because what you watched on January 30th was not the market repricing silver's fundamentals. The Silver Institute's deficit did not change on January 30th. China's export ban did not change. Solar installation targets did not change. EV production ramps did not change. AI data center buildouts did not change. What changed was the positioning of leveraged paper traders who had built speculative long positions in silver futures. When the Warsh headline hit and the narrative shifted toward a hawkish Fed, those levered positions had to be unwound simultaneously. Forced selling of paper contracts drove the price down. Physical premiums actually expanded during the crash, meaning the real-world market for actual silver was tighter, not looser, even as the futures price collapsed. That is not a fundamental change. That is a clearance sale on a structurally undersupplied asset. Let me be precise about why Warsh's appointment is not the silver death sentence that January's crash suggested. The hawkish Warsh narrative is built on a speech he gave in 2011 criticizing quantitative easing. That was 15 years ago in a completely different economic environment. More recent analysis is more nuanced. Macquarie Group strategist Thierry Wisman wrote in February that Warsh has aligned closely with Trump's monetary policy preferences over the past several years, and that while he is unlikely to cut immediately, he could be quicker to ease when economic conditions demand it, and right now economic conditions are demanding it loudly. US GDP came in at 0.7% in the fourth quarter of 2025. Unemployment has breached 4.6%. The Fed's own updated dot plot from March 18th shows one projected cut for all of 2026, and 7 of the 19 Fed members now project 0 cuts despite a slowing economy. That is not a central bank in control of its situation. That is a central bank that is frozen between two problems it cannot solve simultaneously. The stagflation setup is real, and it matters for silver for a specific reason. When economic growth slows while inflation stays elevated, the Federal Reserve cannot raise rates aggressively because that would push a 0.7% growth economy into recession. It cannot cut rates because that would further stoke inflation that is already running above its target. The result is a frozen nominal rate and a real interest rate, the nominal rate minus actual inflation, that drifts towards zero or goes negative as supply-driven inflation rebuilds. The Strait of Hormuz, which the IEA's executive director called the greatest global energy security challenge in history, has handled less than 5% of its normal oil flow since its effective closure earlier this month. Every dollar that oil rises adds approximately 0.4% to CPI within 90 days. Oil went from $70 to over $110 at its peak, even after the partial ceasefire signal from President Trump on Monday, which sent oil down about 10%. Brent is still trading at approximately $100 per barrel. Goldman Sachs published a Brent crude forecast of $110 average for March and April before any ceasefire talks began. The Chevron CEO, speaking at the CERAWeek Energy Conference in Houston on Monday of this week, said the oil futures market has not fully priced in the physical reality of the Hormuz closure. His words, not mine. Now run the real rate math with current numbers. Federal funds rate today, 3.625%, the midpoint of the Fed's current target range. February CPI, 2.4%, collected before the oil shock hit. Real rate on paper, positive 1.2%. But the February data is a historical artifact. It reflects prices before Hormuz closed before oil reached 110, before gas prices nationally rose more than 20% in 30 days. The Dallas Fed published research on March 20th projecting that a full quarter of Hormuz closure raises WTI prices to $98 per barrel and lowers global GDP by nearly 3 percentage points annualized. If May CPI lands at 3.5% to 4.5%, which Goldman and multiple independent economists currently project the real rate at a frozen 3.625%, nominal goes negative, and when real rates go negative, every dollar sitting in a savings account loses real purchasing power. Savers start looking for alternatives. Gold and silver are the most historically proven ones. That demand pressure arrives into a silver market that, according to the Silver Institute, is entering its 6th consecutive deficit year, with above-ground inventory already drawn down by more than 800 million ounces since 2021. Here is the version of this story that nobody is running right now, because most analysts are still focused on the Warsh-Hawk narrative and the ceasefire optimism. The silver market has two completely separate demand engines running simultaneously: the industrial engine, solar, EVs, AI, defense electronics, which does not care about Kevin Warsh's monetary philosophy does not respond to the Fed funds rate and is driven by capital expenditure commitments that were made years ago and cannot be reversed in the next quarter, and the monetary engine real rates, dollar weakness, inflation hedging, which is now being lit by an oil shock the Fed cannot cure with its own tools. In normal conditions, you might get one of these engines firing. Right now, in March of 2026, both are running at the same time. The industrial engine has been running continuously since 2021, producing 5 years of deficits. The monetary engine went dark briefly when Warsh was announced and ceasefire. Optimism hit oil. It is now reigniting as the inflation math reasserts itself. Silver at $70 is the price of a market that has temporarily turned off its monetary framework while the industrial framework continued quietly running underneath. The repricing will happen when the market reconnects both frameworks simultaneously. It always does. I want to give you something concrete to anchor this to because this analysis needs numbers, not just narrative. The Silver Institute's 2026 deficit projection is 67 million ounces. Total mine production is projected at 820 million ounces, growing 1% year over year. That 1%. Mine growth is not a policy choice, it is physics. There are no new major silver mines coming online in 2026. Silver is predominantly a byproduct metal. 72% of silver production comes from mines primarily targeting copper, zinc, lead, or gold. Those mines cannot increase silver output significantly by choice. They produce what the geology produces, and the geology is producing roughly 1% more per year while demand is structurally elevated by 3 industries growing at 10 to 30% annually. JP Morgan published a 2026 annual average silver price forecast of $81 per ounce. Silver is at 70. Today, that is a 15% gap between where silver is and where the most sophisticated metals research team on Wall Street thinks it should be on average for the full year. Bank of America's metals research team published a scenario analysis ranging from $135 to $309 per ounce depending on the gold to silver ratio compression. Those are not price targets, they are scenarios, but they are published by one of the largest financial institutions in the world, and they are built on the same supply deficit math the Silver Institute has been reporting for 5 consecutive years. So here is the picture as it stands today, March 25, 2026. Silver is at $70. It was at $120 in January. The crash happened for real reasons: leveraged paper position liquidation, Warsh hawkishness repricing, and temporary ceasefire optimism on oil. None of those reasons permanently altered the underlying physics of the market. The deficit is still 67 million ounces this year. The cumulative drawdown is still over 800 million ounces since 2021. China's export ban enacted January 1st and classified silver as a strategic national material is still in place and still permanent. The AI build-out is still consuming silver at rates that dwarf anything the solar industry alone was doing a decade ago. The real interest rate is still heading toward negative territory as an oil-driven CPI rebuilds in data that will not show up in the headlines until mid-April. What has changed at $70 versus $120 is the price, and in any commodity market, when the price corrects significantly while the physical fundamentals remain intact, the question is not whether the price recovers, the question is what the timing looks like and what catalyst reconnects the paper market to the physical reality that has been quietly running underneath it the entire time. There are 3 catalysts on the calendar in the next 51 days. The April CPI print, which will be the first data release to reflect the energy shock from the Hormuz closure. A higher than expected number will reopen the real rate conversation that the ceasefire optimism briefly closed. Kevin Warsh's Senate confirmation and transition, which resolves the uncertainty about his actual policy stance and uncertainty that the market is currently pricing at worst case when the reality is more nuanced, and the World Silver Survey 2026, which the Silver Institute has announced will be released on April 15th, a comprehensive accounting of every ounce of supply and demand that will place the 6-year deficit in full public view right at the moment that the CPI data is shifting the monetary conversation. 3 catalysts, 51 days, into a market that is $70 below its January high with 800 million ounces of cumulative deficit underneath it and 2 independent demand engines running simultaneously, one that does not respond to Warsh or ceasefire news and one that is being rebuilt right now by an oil shock. That the Chevron CEO said the futures market has not yet finished pricing. That is the silver story in March of 2026. Not a monetary metal that goes up when rates go down. Not a smaller, cheaper version of gold for retail investors. The most critical conductive material in the infrastructure of artificial intelligence, clean energy, and electric transport simultaneously sitting at the intersection of the most persistent supply deficit in modern commodities history and a macroeconomic environment where the real interest rate is heading negative with the Federal Reserve frozen in place. The misclassification is the opportunity. The market is still pricing a 1980 era monetary metal. The physical market is pricing the backbone of the 21st century economy.